Good morning, welcome to Money Investment for All. In this video, we'll see what is debt to equity ratio, okay, and PE ratio and return on equity. In earlier videos, I have covered PE ratio and explained also in another video ROE, what is good ROE, what is bad ROE. Okay, in this video we'll do comparative analysis with the case studies, with examples. These are important stock fundamentals. These are stock fundamentals required to buy a stock or not. Okay, whether based on the fundamental analysis of these values, one should decide whether to buy a stock or not. Disclaimer, please read this disclaimer. Okay, let us see what is debt to equity ratio, DE ratio. It is the debt a company has compared to its total assets. Okay, how much debt it has compared to its assets. How it is calculated? By using this formula, debt to equity equal to total liabilities or debts divided by total assets. Okay, total assets equal to assets minus liabilities. Okay, company assets and its liabilities, that is equal to total shareholders equity. Total assets is also called total shareholders equity. Okay, now let us compare P by E ratio, price per earnings. So share price divided by earnings per share. Okay, now return on equity. What is return on equity? This is similar to DE ratio. Here you put debt by total asset. Okay, here net income or profit by total asset. Net income divided by total assets. So it is inversely related, ROE and debt to equity. Okay, let us take few examples to show how much debt to equity for Mahindra and Mahindra. It is equal to 1.61. TRENT, Tata TRENT textile fashion company, it is 0.43. So TRENT has got lower debt to equity ratio. Okay, now many people ask why banks and non-banking financial companies will have higher debt to equity ratio. For example, Power Finance Corporation, a public sector undertaking unit, 8.52. Cholamandalam, it is again a finance company, investment finance corporation, 6.86. They have greater debt to equity because the reason I have given, even banks I have not given here, banks will also have higher debt to equity ratio because they borrow, they get money through FD, RD with interest rate 6.57%, and then they lend the borrowed money to the customers as home loan, bike loan, car loan, etc. at 8 to 8.5%. Okay, so since they borrow money, they have more debts, so the DE ratio is higher for them. It is so natural for them. We need not worry about it. Okay, now let us demonstrate which is best debt to E ratio, debt to equity ratio, by comparing the two companies. Okay, let us call company A. Okay, and the details are as follows, and let us take company B and the details are as follows. I will explain one by one. Company A needed 1 lakh rupees, okay, and they obtained through equity 50,000, and they borrowed from bank at interest rate debt 50,000. Okay, see company B, let us compare side by side. The company also needs 1 lakh rupees, but they collect all the money through equity shares 1 lakh. Okay, so now here debt equal to 0. This company B has 0 debt. Okay, now let us calculate debt to equity. So debt is 50,000 rupees divided by equity 50,000 rupees. Therefore, debt to equity ratio 1.01. Whereas for this company, debt is 0, therefore 0. D ratio 0. Okay, now company A makes profit rupees 20,000 rupees, and similarly company B also makes rupees 20,000 rupees. Now net profit, here net profit 20,000 rupees. Here, since the company A has borrowed loan, they need to pay interest at the rate of 8%. Therefore 20,000 minus 4,000, that is equal to 16,000. Okay, so this is the net profit after subtracting debt and liabilities. Okay, this now ROE, let us calculate ROE. This is the profitability of the company. Profit ROE equal to profit divided by total equity shares. So 16,000 divided by equity 50,000. This comes 32%. It gives return of 32%. Whereas this company, you see, company B, profit 20,000 divided by, okay, 1 lakh rupees, 20% only. So company A, although it has got debt to equity ratio higher, okay, 1, this is just 0, but company A is better because of return on equity. Okay, so company B, although it has debt to equity ratio 0, it gives us return only 20%. Okay, based on the above, we can decide now what is good and bad debt to equity. Okay, so for a good company, debt to equity may be in the range 0 to 1.5. For a bad company which is not doing good, debt to equity ratio is greater than 1.5, that is 1.7, 1.8. It is financially not healthy, it is risky company. Okay, thank you for watching. Please share and subscribe. Thank you again.